Hello again, everybody, and welcome again if you are return participants, and welcome if you are new to our series. It's all good either way. Tonight's topic is investments, and Mr. Smith is going to cover all you ever wanted to know and more about investments. We have with us also on the line is Simone. She is our technical support for the evening. So if you have questions related to, in regards to needing tech support, she'll be able to field those for you. Hi, Simone. Thank you. But without further ado, I want you to introduce our host and instructor for the evening, and that's author and educator Jaz Jasper Smith. His book is The Build Wealth Challenge, and I've read it. It's great. I'm going to read it again. And I'm not a book reader, so that will tell you something right there. So take it away, Jasper. Thanks so much again for being here tonight.
You got it. Thank you so much, Charla. And I'm going to do a little bit of housekeeping before we hop in, as people are still kind of rolling into the session. So there were a couple questions that I just want to make sure we get on the record from last week, where we had some really good discussion, and I just want everybody to be mindful that these are recorded sessions. And so if you have remarks, just be mindful of the language, just because we want to make sure we can share this ongoing with the community. But unfortunately, we won't be able to share last week's session due to some conversation that we had during the session. So just be mindful. We love passion. We love the exuberance. I just want to ask everybody to be respectful when you're on the mic. We understand, but again, we want to try to keep it as clean as possible on these sessions, just because these recordings will be going out to the community. But in lieu of last week's recording, I shared the deck with Simone. And so if people, in case they wanted to kind of get a recap, then they'll at least have the deck that was presented last week. So we're good on that one. And then there were two questions that I saw that I did want to make sure to address on this session, because they were important questions that we had such a great discussion, but we're gonna be here but so long. And they were around, if I'm single, why do I need life insurance? And I didn't really get into like an in-depth conversation around it, but this was in the chat last week. And so even a single person needs life insurance, just because if something were to happen to you, who comes in and finishes up closes out all your financial affairs, packs up your apartment. And so I used to tell the example that I'm from North Carolina, so I don't have any family, really close, meaning if I were to die, somebody's got to fly out here and clean up all my stuff. So that's one reason why having enough life insurance is important for even the single person who may not have a ton of assets at this point. But also there were some of those alternate uses that we talked about, and how some people leverage life insurance as an alternate retirement planning option. So even if I'm single, I may not have a need for the insurance, but I could be leveraging this tool as a way to put away tax-free money. And so I just wanted to make sure I answered that that question or that comment on the recording here. And also, Charles, I think you had asked this one, was around, is life insurance considered an asset for loans? So depending on the business, sometimes a lender may ask you to take out an insurance policy as collateral for a loan. So I think that's what you were kind of alluding to, Charla, last time. And yes, I've done a policy where it was going to be assigned to the lender. So in case something happens while this business owner, in case she died before the loan was repaid, the lender would recoup the money by way of the death benefit. And so they don't necessarily consider it an asset per se, but it could be used as an option to help with repayment in case you do pass away sooner than expected. So I wanted to get those on the record, on the recording, because those are important reasons. So if I am the entrepreneur, again, that's that business option where even if you're in business, it might make sense to have a policy, because again, you can help, maybe get a loan and they know that, oh, she's good for it, because in case she dies, we'll get the money. If she lives, she was going to pay us back anyway.
Right. Excellent. Thank you. I appreciate that.
Yeah. And then for tonight, if this is your first time joining us, again, my name is Jasper Smith, also known as Mr. Bill Wealth. And this is part 5 of our 6-part series. It's crazy how I remember we were just starting this session and we were walking through all the different modules, and here we've come to the investment session. And I was making a joke about this last week, but if you all notice, we already got 28 people on. And last week we had, I think, maybe 16, 17 for life insurance. But people always show up for investments. I wouldn't be surprised if a few more people trickle in for tonight's session, just because investments is the topic that everybody wants to talk about. And there's a lot to unpack. So as all these sessions have gone, it's just, I don't have but so much time to kind of give you the highlights of things that I think could be helpful as you do your own investing, figure out your investment program, whether you're just starting out. And so I'll try to do my best to give you, I'll say, the foundational pieces that I wish everybody would go through in life. And I realize too that we don't get a lot of these lessons sometimes until we're well into adulthood. And I just think about if we all had some basic level of understanding of investments from an early age, I think more of us would be fans of the stock market or just investing in general. And I think we would alleviate a lot of stress when it comes to actually building wealth or creating a legacy, because you can only work so many hours in a day. And so, whatever you are into from an investment standpoint, the idea is that's stuff you're not working for, potentially, right? You set it, you hope it goes and does wonderful things for you, produces a return. We know investments have it's kind of this double-edged sword where things go up and things go down. But it's a time factor. And so I think we understood that the longer we're working on doing investments in general, we should do well over time. So just want to give that disclaimer before we hop in. And as always, I wanted to kick this off with a couple of poll questions. So Simone, if you want to go ahead and launch the poll, we'll give people a couple of minutes because these are a little lengthy this time, but I want to just kind of set the stage like we've done every session. Just we'll take a couple of minutes here to allow everybody to jump into the poll. And just so everybody knows a little background about these poll questions as you're reading through and thinking them through, this first question around, aggressive investments have historically provided higher returns, but then there's that short-term price fluctuation and or potential loss. And so it's really getting into your mind of thinking like, how do I process risk? So we know being aggressive could be helpful, but there is that potential for loss sometimes in the short term. And that first question really speaks to getting kind of this understanding of how you personally feel. So this isn't some, you're trying to answer this based on somebody else's, responses or thoughts towards investing, but it's simply just, how do you feel about it? And then the question 2 is around this last big dip that a lot of us remember because we were all around in 2008. And so I give you this kind of hypothetical that, you had an investment portfolio at the time. It was all stocks. Let's just say that to make it simple. What did you do? So I give you a couple of different options on it's 2008, things are getting rough. What did you do? And give me your honest answer. Don't try to answer. Don't give me the answer y'all think I want to see. Like, be honest with me. What did you do in 2008 when that happened?
What if you didn't have any investments back in 2008? How would you answer that question? Because you don't give us an option.
Right. Let's act like you did. Yeah.
Okay. Yeah. Weather the storm. Let's weather the storm.
Yeah.
Okay.
Yeah. Let's just assume you did. Yeah. Yeah. So this is just, and this kind of stuff will change over time. So it's not, it's not set in stone. And we'll talk about risk during we had a whole slide to talk about risk. So we'll have that discussion. All right, good deal. Okay, so I'm just taking a look. Weather the storm. All right, so it looks like the majority of folks on the first question want to, want to minimize the losses. I mean, I'll say about another almost half of you mentioned that You can tolerate some moderate losses in an effort to, achieve a little bit better return. And then some of you, the smallest percentage say I can tolerate a lot of risk, which means I'm cool with being aggressive. And then question 2, more than half kind of put, hold on tight, weather the storm because it was bad, but you want to sit tight. And I said roughly about the same percentage of some of you would double down and buy more because it's on sale. And then about the same percentage would sell half and then hold on to the rest. And then some of you said, we just gonna get out because we got out. So that's all good. So thank you all for indulging me with those questions, because that's really indicative of how you have to think about investing, is that risk component, which we're gonna definitely touch on. So give me a moment here. I'm going to get my deck ready for you all. All right. And just like last time, you all, I will do my best to try to manage this chat to the best of my ability as I get through the material. If I get a little, if we get a little sidetracked or we have some good discussion, again, we'll make sure to finish on time like we did last time, and I'll make sure to get those questions answered if I've missed a few things. So just, we'll get through just like we've been doing. So, so my goal for this session, it has not changed. It's to change the way you think and the way you feel about money in order for you to achieve financial peace of mind. If I can change one of those, I've done pretty good. If I can do both, we can make some things happen. And it's literally just these thoughts and feelings that we have towards money and towards investments, which we'll talk about tonight, that I think just it stifles some of our growth and ability to really do this thing called financial planning the right way. And if we can just get past some of these roadblocks with how we think about some of these things, or even, unpacking some of these emotions, it is, my gosh, you'll have so much more freedom. One of the key things about this conversation tonight is all of you have to not get emotional when it comes to investing. If you can take out the emotions, you will go a long way with this investment stuff. And it's not something that you'll be able to develop overnight. So again, as always, give yourself plenty of grace. We've got to get comfortable with this notion that things can go down, but it's not the end of the world. Because that's sometimes what we think about when we're talking investments. We just think, I could lose it all. And it happens, but, we got to be mindful of the strategy we're taking. And so again, as we go through tonight's session, just really think about how you process information as it relates to investments, whatever the investment might be. So as we think about investing in general, I want to tell you all this story because this is a diagram I drew probably about a decade ago, and I had to draw it out of necessity. So I served as a financial advisor inside of a bank. And so people will walk in, do their banking business, and then just hightail past my desk, like almost didn't want to wave at me, acknowledge me, would do all in their power to avoid me. And I kept hearing the same exact thing. Well, Jasper, if I come see you, I will lose all my money as soon as I put it in. And I was like, well, that's not technically how investment accounts work. And so I kept hearing that over and over. If I just throw some money in, I just might lose it all tomorrow. And I was like, actually, you're not. Now, this diagram is, of course, the epitome of how an investment account actually works. But back then, we didn't have a lot of the apps that some of you may be familiar with now, that you open the account, put the money in, and it goes right into the market or right into an investment. So there are platforms now where they don't really fit this diagram, but still at its core, this is how an investment account works. And so I'll start at the top and just talk about you opening the account and making a deposit. And so when you make that deposit, it goes into, I call it the cash portion. So this could be, it may say cash on your statement, it may say money market, it may say something else, but essentially it's the investment account, and the cash portion is kind of like that holding tank, because we haven't made a decision on what we're going to invest in. And so if you made a deposit and then you just got cold feet, you can take the money right back out. No harm, no foul. So money can always flow right into the cash. You can take it right back out. The money market or cash component of an investment account typically will get, interest rates similar to your bank savings rate or your credit union savings rate or money market rate. It's not going to be that much higher because it's essentially that holding tank. And so while it's there, now you're thinking to yourself, well, what is it that I want to buy? And that's where you would have to place a trade. Now, a lot of people do their own trading right online or from an app. And so for me, I used to have to place a trade on the system, or I'm not that old to where I used to have to call in the order, but I would still go online and essentially call in the order. And so no matter what you were going to buy, I would say, hey, now you're going to put some of the money in cash actually into the market. So we're going to buy something. And let's say the money's sitting there for some time. And so when you get your statement, you'll have the larger account balance, which would be at the top of the page. And then you'll see the breakdown. So the breakdown of this first step is I have a little bit of money in cash, and maybe I took half of that and invested it into a stock. So now I have 50% in cash, 50% in the market. And so let's say a year goes by, the stock doubles in value. So another order has to be placed. And so now we sell some of the stock, maybe half of it. And we drop that back into what's called the cash bucket or the holding tank. So now we've made some money. We have left some money in the market. So now we've increased our cash component in that holding tank. And then we still have some money that's actively invested. And so when I started breaking this down, I realized people didn't know this is how it worked. And again, this diagram came out of necessity. I had to figure out how could I get people to see that just by talking with me, they weren't just going to lose all their money from day one. So hopefully this diagram was helpful to explain how an investment account works in its rarest form. This is, you open the account, you put some money in, and then you make a decision on where the money goes. All right. So I'll pause there for a second. Any questions about this diagram? Is everybody okay with this? Hopefully I've broken it down in a manner that's kind of easy to digest, because I want to make sure you all are following me here, but just want to make sure, if you got a question, feel free to chime in. I'm gonna take a quick sip of my tea here. Give me one moment. Got a good question in the chat. Let's come back to that. So I got a question around, I'll call it the meme stocks. So we can talk about that in a little bit, but yeah, we can talk about that. And I'll tell you a story. I got a good story about the meme stock stuff that happened during the pandemic. But Levin, I'm gonna tell a story first. I want to, this is relevant stuff that has happened, in the last couple of years. This meme stock stuff was, it's an incredible adventure. But yeah, I got a story I'll share with you all about some of the meme stock investing. So yeah, I made a note here, and yeah, we'll definitely tackle that for sure. All right, so now that you all understand how an investment account works, give you all some more kind of investment one-on-one type of content here. So here's what typically happens. What goes up must come down. And this is a diagram that applies to pretty much everything you might want to consider investing in. It's a cycle. So whether it's stocks, real estate, it's the economy, there's always going to be this kind of up and down. And so what happens is when things are getting good, everybody wants to rush into it and buy. If you notice there, you're buying at the top. I mean, unless you were working with somebody who was coaching you on when to buy and when to sell, this is what most people do. Everybody talks about something, they buy, and then it kind of fizzles out or maybe plateaus at the top, and then it kind of takes a dip. And then everybody gets afraid at the bottom and sells out. And I'm thinking, wasn't the best time to sell, but then you do it again. So we understand in theory this buy low, sell high, but this right here is what most people do. It's just because we're human and we're emotional. So we got this question about the meme stock. That's exactly what happened to some of those. It started going crazy. Everybody started buying, and then they kind of fizzled out. And then people like, I need to get out of it. Maybe I sell out. Was there a long-term expectation that these stocks or these companies were going to do well over time? The verdict is still out, but that's what happens. People hype things up. And if you are getting to something at kind of that top portion, look at all the growth you've potentially missed. That's what happens, right? By the time you catch wind of it, people made a lot of money. They may be cashing out while you're still getting in at a higher price. So if I were to ask any of you, if you had a chance of buying whatever it is you're into, your favorite item, would you want to pay full price, a premium, or would you want to get it at a discount? And the majority of people are going to say, I would love to get my favorite, whatever it is, at a discount. Like, well, why? If I don't have to pay full price, why should I? And that's what happens a lot, because we get emotional, like really emotional. Like we get afraid. We start watching and consuming media and content that just, I'll say, solidifies our thoughts around some emotion towards a company, and so this is what, again, most people do. So what I would hope that you all can do is right here on your right here, sell at the top and buy low. So this is how that, you do that buy low, sell high. So let me give y'all a real life example of this scenario and how it could potentially play out. Now, the story I'll share with you is, I would say, it's not a cautionary tale, because this young lady is actually a current client now. And my partner and I, we had multiple conversations about these diagrams. And this was stemming from the war in Ukraine. And so it's not a secret that gas prices have gone through the roof. And so this young lady had a substantial amount of Chevron stock in her account. And so we explained to her that when you have certain accounts, depending on what the goal is, you don't want to have so much money in one company, because it could make or break the long-term performance of that account. And so her Chevron stock, and I'm never going to forget this because we're actually tracking this as a real life case study right now, it was trading at $115 a share back in November when we first started talking about kind of changing some things up. And we couldn't have predicted this war. And so we were kind of going back and forth. She hadn't made any decisions, but we've already explained to her why being overly exposed or overly, what's the word I'm looking for? Overweighted. Like, she just has too much in this one company. So she got lucky, y'all. She got lucky. With the war, gas prices go up, Chevron stock prices goes up. So in a matter of a couple of months, Chevron was trading at $165 a share. If you all want to check to see what it's trading at right now, I'm not making the story up, but it was like at $115 in November, give or take, and it was at $165 a couple of weeks ago, early this month. And so we got her to kind of, that sell zone that you see here, we got her to sell it out, because she made almost $250,000 in the last 5 months off of that one stock. She got lucky. There was no skill involved with her waiting and not making the move before this month, but she got lucky. And so all the analysts online were talking about how Chevron is not going to be this growth-oriented stock company over the long haul. We're going green as a society. So where does oil, like big oil, fit in? It's still not going anywhere anytime soon, but it's just not going to do crazy numbers by way of a stock price. And so she got lucky. She got lucky. So could we have predicted the war? I mean, if we did, I wouldn't be here today. I'd be on my spaceship, because I would have banked a whole lot of money. But she got lucky, y'all, because in her brain, and if I'm thinking about investments, it was so good. It was so good. And she wanted to hold on. And we had this honest conversation with her around, you can hold on if you'd like to, but here's the reality. It won't keep going up forever. And at some point, it's got to go the other way. What day that happens, I don't know. I don't know what the market is going to think about Chevron on some day in the future. And so in order to kind of what we call booking her gain, like, she had this crazy run up. I mean, 250,000 in a couple of months. I mean, I wish I had that kind of luck every day. But the reality was we were like, book that 250 and then let's go buy something else that's cheaper or that's on sale. So we reallocated some of that money to spread it out, to take advantage of that incredible growth. But if she doesn't have us in her life, she does not do that. And she probably becomes a cautionary tale because she wasn't confident enough in her investment like life to be able to make that decision on her own. And I'm so thankful that she had myself and my partner to help talk her through that scenario, because from here on out, I'm just going to track Chevron stock just to see if it holds this price, if it dips in the next 6 months or to a year. But at some point, I have to keep watching, because she was a real life example of what the average or even sometimes the novice investor does, is that they're so unsure because they're being blinded by the success. So when everybody's running to it, you might want to consider running the opposite direction. When everybody's running scared and there's fear, best time to buy. I love shopping on sale. So that second question of the poll is really that bottom portion of, yeah, you should have been doubling, tripling down if you could. I mean, think about people who if we're talking about retirement, which is on Thursday. I mean, if I wasn't planning to retire anytime soon, would it make sense to just get out? I mean, and for some people, they were so fearful that they did. But if I wasn't retiring anytime between 08, 09, 010, or 2010, let it ride. Because I have a slide that I'll show here a little bit later on, but there was an incredible run in the stock market after 2008. And so a lot of people were not even in the market. And then some people got out way too soon and didn't give themselves an opportunity to really make a lot of money on the comeback. So Mr. Medina, there's always conspiracy theories about information that analysts share. Take it with a grain of salt. I'm always big on checking multiple sources, checking credible sources. And this is why it's important, to your point, Mr. Medina, around having an advisor. Maybe you just have a person that helps you with your investments, because you need to get some real perspective from people who do this more than you do. Or maybe you have the time and want to dive a lot deeper. And so, they know that sentiment alone moves markets. And if there's any indication of how this works, when who always gets in trouble? Elon Musk. He always gets in trouble for tweeting something. But Tesla's price moves. If that's any indication of how emotional the markets can be, which is why we have to become better at taking the emotions out. Elon knows what he's doing when he sends these tweets. He gets somebody talking about it. He gets in trouble. Like he's on the edge. He's keeping you in the news. So markets move. His company's price moves. But just keep this in mind that buying low, selling high sounds good in theory. It's extremely challenging to implement when you're doing it by yourself. So I'm always going to encourage people to really work with a professional to help you to make these decisions and not get caught up in this trap like the exhibit on your left, where you get greedy, you buying at the wrong time, and then you're getting fearful and selling out at the wrong time. All right, so next is risk. That first question of the poll discusses risk, and it's important to understand that investing should be, I'm saying should be done for the long term. There are plays you can make on an investment standpoint that, you're trying to make some quick money, but when you're first starting out your journey, I would recommend against it, because it's a lot of work to really do when you're new. And so what tends to happen with our risk, and this is true, if I'm new to it, I tend to not be as aggressive, although I know taking more risk will potentially allow me to earn more in the long term or even the short term. If I play it safe or I'm more conservative, then I shouldn't expect a high level of return, because I'm not putting enough money at risk. So I know the money will be there. So for example, like a bank account, right? If I got to pay bills, I want to keep that in a checking account, very low on the risk spectrum, because I need that money to pay my bills. But I'm thinking about my retirement, I may be on the very high side, or high or very high, simply because retirement is 20 years, 30 years out. So I need this money to be working just as hard as I am because I know that if I do this for the long term, even despite some losses, I'll come out on top. And so we all kind of fall in this continuum. We all have maybe different accounts that are earmarked for a particular level of risk. And that's also another strategy you want to think about with your investments is you should understand, well, how risky do I want to be with this pot of money? It should be very clear. If you're unsure, you need to have that conversation with an investment professional, financial advisor, somebody's. You need to get some guidance around, am I taking the appropriate amount of risk for the goals that I want? And there's some general rules of thumb around risk that I think are okay, but I think it sometimes limits people because they get caught up in what the rule says, but the rule may not apply to you because, again, all of our financial plans, which I've alluded to in some earlier sessions, that is that your financial plans should be unique to you, and so should your investment strategy. There are a couple of things everybody might want to consider, but maybe it's not something you should consider. So with risk, when I'm new, again, I may not want to take a lot of risk because I'm uncertain, and that's fair. You want to dip a toe in. Let's see how it works out. Let's do some comparison. Let's see if I play it safe versus taking a little bit of risk. What happens over 3 months, 6 months, 9 months, a year? So in the short term, sometimes that very safe option looks very good. Looks very good. There's probably somebody out here who's like, I'm afraid of investments because I'm just afraid of this potential loss. But playing it too safe also causes you to lose out just to inflation alone. So if I'm being mindful of the times we're in right now, you know, I get into a lot of discussions around people who don't want to take any risk. And then I say to them, well, if that account you're drawing at your bank is 0.0 nothing percent, or even if you got a higher rate, maybe 2 or 3, are you even keeping pace with inflation? So you feel safe and secure because your money's there, but you're already losing purchasing power over time. And that's why I say that there's risk in every account that you have from a financial planning perspective. There's risk in every single thing. Again, the person who says, I'm just going to keep my money in the bank, it's not safe there because it's going to lose purchasing power over time. Because just think about how much gas was 5 years ago, 10 years ago. Think about eggs and milk and bread, just basic things we all need. Think about how much it cost you years ago. It wasn't as high as it was now. And so sometimes you don't have to be on the far end of the spectrum with high risk, but I want you to think a lot longer through this process, because as you learn more, you'll get more comfortable with risk. Also, as you earn more. So as I earn more, I tend to take more risk because I have more money to spare. And that's just a general rule that, you know, when you didn't have it, you want to hold on to everything. You don't want to risk it because this is all you got. But as you earn more, as you progress in your career, in your businesses, you start to kind of feel like, all right, I think I got this. I think I can do this a little bit more. And so you do. And then some of you may say, you know what, I'm trying to put my money to work just as hard as I am every day. I understand what I'm doing, and I got to push it to the max. And I'm going to be very aggressive. And so you're not right or wrong with whatever decision you make on this risk continuum. I just want you to be aware. Be aware of what you're doing from a risk perspective. And if you're trying to figure out where you fall in this continuum, there are some tools. If you, I probably should have populated one for this session, but if you type in like risk tolerance questionnaire into your like search bar, they're everywhere on the internet, because what it does, it's an extension of the 2 poll questions that I asked earlier. It's going to put you through or ask you about scenarios. And just know as you go through life, your risk preference may change. But the reason I said earlier that the rule of thumb about being young and being aggressive and being older or more seasoned being more conservative doesn't always pan out, because you know, if let's say you're nearing retirement or in retirement and you have substantial assets, you want to make sure that money can last for the rest of your life because you're no longer working. So if you play it too safe, you can run out of money. So taking risk there could be beneficial. But if I don't have a ton of assets and, you know, I need this money to stretch a lot further, then maybe I don't take as much risk. Maybe I'm a little bit more conservative because I have a smaller nest egg to utilize. But again, we all will flip flop on this continuum. I just want you all to understand this is one of those key components that a lot of people forego when they get caught up in the hype of like the meme stocks, which we'll talk about in a little bit. That kind of stuff is just, we're just hopping in because everybody else is doing it. And it's like, is this in alignment with your risk preference? If it is, go ahead and do it. If it's not, I want you all to think a lot longer about where you fall in this risk continuum. All right, I'll pause it for a second. I've been running through pretty quickly tonight, but if you got a question, feel free to take yourself off mute. And if you want to ask a question, or if you want to pop something into the chat, I'm going to take another quick sip of my tea here. All right, so it looks like we're good so far. So we'll keep this show on the road. So time is really important. I'll share, here's what you all got to think about. And I want you to remember this line, because some people get into trouble because they're trying to, I'll call it time the market, meaning they're trying to always guess, is today the right day? Is tomorrow? Is this hour, the next half hour? And timing the market is very challenging over the long term. I'll always say this, you might get lucky. That's all I'll say. You can get lucky, but if you're really good at investing, can you always pick the right time to get in or get out? Average investor will miss, if you're trying to time it in and out, you may miss the best days in the market because maybe you got busy that day. Maybe something came up with your family. So trying to time the market can be extremely challenging just because it's hard to maintain over a longer time frame. The key is be in the market. Time in the market is what I want everybody to do. Get in, be in the market. So time in the market is what I would profess over timing the market, because time in the market means you're going to have some ups and downs, but if you're sticking out in the long term, you should come out on top if you're making the right decisions. But you might not always pick the exact perfect day, right? So that's the part where just understand that if I stay in there long enough, it should probably work out in my favor. But what happens is you talk to your friend, you see something on TV, social media, the friend got lucky and now they claim to be an expert, which is far from the truth. And thank you, Mr. Medina. Selling is one of the hardest things that people struggle with is, well, when's the right time to sell? It's up to you, right? So I got another story, personal investment story. So I struggle with trying to do this timing thing because sometimes I'm human. I think too long about something. Like, I'm not emotional with my investments, but I sometimes think too long to make a decision. And sometimes it's on, I'll say, the sell side and the buy side. So I've had some stocks that I bought in at a low price, but I didn't set kind of this limit of how high would it, or how high can it go where I would feel comfortable selling some shares, like either some of them or all of them. Now, if I know I want to hold a stock for life, then that's not a part of this conversation. But sometimes it's okay to sell, because whatever you sell off, you can make some money. And if I was that connected to whatever that investment was, I could probably buy it again. Like, just because you buy and sell something one time, especially if we're talking about securities or stocks or funds and things like that, you can always get back. We'll stick with this Chevron scenario. Maybe I got in at 115 and sold out at 165. So I banked all this money and I sold out at 165. And then let's say Chevron drops down again to, let's say, 100 a share. Maybe at that point I'm like, hey, I want to buy back in. And maybe you buy back in. Maybe it goes up a little bit more, But here's the thing about timing also. People, whether the markets are going up or down, people are making money. That's the key. Now, I'm not one of those who really bets on things going down. It's a strategy where it's called shorting, and you can make a ton of money. You hope that the company over maybe a shorter period of time, maybe there's some bad press and the stock price takes a hit. Let me give y'all a real life example so you can understand this timing thing. So if you all can recall, I don't remember the exact year, but does everybody remember the BP oil spill in the Gulf of Mexico? And if so, you just put like I did in the chat. You say, yeah, I remember that. Like it was a big event. Like BP, big oil company, had a big issue in the Gulf of Mexico. And so this is one of those times where, because again, we're talking about timing, I was sitting around thinking like, okay, there's only been so many, I'll say, large oil companies in the world. And they, it's a short list of those companies. And so when it happened to BP, I was sitting around thinking like, man, I don't think BP is going to go out of business. And that oil spill was bad. Like that was a bad event for the Gulf of Mexico. And so I watched the stock price just dwindle. Now, granted, if I was one of these people who was like betting on things going down, I probably would have placed a trade and said, okay, I think it's going to get to maybe this price and I'll just book whatever gains I can from that price dropping from, let's say, $100 to $90, something like that, right? But I didn't do it, y'all. Didn't even do it. And it probably dropped substantially. And then, of course, BP is still around, still doing oil. They cleaned to the best of their cleaned up the Gulf the best they could. But just look at what happened after that oil. If you go back and look at the record of a stock, you can see what it did. That oil spill was bad, but at some point it bounces back. And most companies of that magnitude don't always go out of business. But that was one of those opportunities that I missed because I took too long. So timing is really important when you think about investors because they don't wait for you to make a decision. That's the sad part, right? It's like the bus. The bus, you missed the bus, another one should be coming, hopefully, if it's not the last one of the night, right? So with investments, I had to learn that where sometimes I take too long to make a decision, I miss an opportunity to buy or sell. So timing, when you're thinking about investments, is extremely important. It's just hard to sometimes hit that button or make that execution. It's hard, y'all. But I'm human too. I don't always get it right. So again, if I'm new to investing, you want to think about this timing component well in advance of you making the investment. Well in advance. How long do I want to stay? If it reaches a certain level, do I cash all of it out? Do I cash out half of it, take the rest and take it somewhere else? Or what is the time parameter of how long I'm going to be in said investment? It is a big piece that if you're working with a financial professional of any sort, they should be asking you that question of how long you plan on being in this. Timing is super duper important. So the next one, as you're thinking about your investments, it's kind of a two-part, like how much and how frequent. So how much really stems from the conversation we had a long time ago. Well, it's been a couple of weeks now, but that was the money management session. So for everybody who was not in attendance there, hopefully you go back and review that recording or think about your budget, because I always get a lot of people who, reach out to me and say, I want to start investing. Like I haven't done it before, or I need some help with it. And I always ask, how much are we talking about? I always ask that question. And this is why we designed this program the way we did, is because if we followed all those steps, then we'll know exactly how much we can do. And how much we could do could mean I do let's say a lump sum of like $1,000, and maybe I just let it ride. I put in 1,000 and I sit back and just watch it work. Or maybe it's I have 1,000 to put into some investment, but I'm gonna do it in increments of $100 over the course of 10 months. So how frequently do I want to make contributions? Where we also have, if anybody here is a part of an employer-sponsored retirement plan, like a 401k, 403b, or 457, well, some of this is already taken care of for you because it's automatically taken out of your check. So every 2 weeks, boom, done. You're contributing X percent out of your paycheck or X dollar amount. So every 2 weeks, that bucket is getting filled up. Now, you can do the same thing with your general or retail investment accounts. So I could, everybody on here could go open up an investment account at some firm and say, you know what, I'm gonna drop in $100 to start, and then I'm gonna start doing $50 every month, and you can set it up on autopilot. So when you're thinking about how much you want to invest, well, how frequently do you want to put money in? Is it a one-time thing? Is it multiple times, over the course of a year? And there's no right or wrong to any of this because this has to be suitable to you. So again, if you don't know how much, I need you to backtrack, take a look and see, hey, how much do I have to put in this investment, or even to start this investment program? How much do I have to work with? And if I'm going to do ongoing contributions, well, how frequently do I do it? Somebody may say, hey, maybe I just wait until I get my annual bonus. It's a great time to do it if you get bonuses, or if you get commission checks, or if you're in business, every time you close a deal, maybe you carve out 2% of every deal you close and go invest it. And maybe that's a program that you implement. So you have a lot of different ways on how you can do this. It's really important to know how much money am I playing with. All right, so let me take a look here at the chat. Yeah, Sharon, study long, study wrong. This is, I probably should have said this too. It's called paralysis analysis. Some of us make or take a lot of time. We make a lot of time for like doing research and asking people and attending webinars and watching YouTube videos. Like we do all this research and then we never make a decision. And again, that's the hardest part for some people, is to part ways with their money, knowing that if they do this, it might work out. Maybe it's the fear that's stopping them from placing the trade, but sometimes we take too long, y'all, and the opportunity just goes right on by. And another one comes and you're like, all right, I'm thinking about it, and it goes by. At some point, you got to say to yourself, what's the holdup? What is this? What is it inside of us that's stopping us from doing it? If we already know how much, the risk, the time horizon, like what else is it? And if it's the fear of the unknown, I'm gonna ask everybody to just jump in. You gotta just jump in, because that's the way to really get that experience, is just do it. And maybe you don't part ways with all of your money, but I love doing this comparison tool where you do what you're comfortable doing, and then maybe take a little more risk and do something that you're uncomfortable doing, and just watch how they perform over time. That'll be the proof that maybe what you're doing, maybe you should change it. So let me see here. I got some more stuff in the chat. Okay. Yeah, a missed opportunity is just that. Yeah. Yeah. So Mr. Medina, there's a lot of smart people in the world, is what I'll say. He kind of mentions this hedge fund comment here. There are a lot of smart people in the world who do this every day in, day out. They're analyzing millions of data sets. They're watching what's going on all across the world and in certain industries. Yes, we know there's market manipulation. There's all these things that are happening every single day that the markets are open. But we got to stop thinking about what they're doing. And that's the problem with a lot of people with their investment programs, is you're not a hedge fund. So keep your program simple, right? We know these things exist, and maybe we want to explore some on our own, but we got to start learning how to stay in our space. Like I do this with my clients. I don't work magic, right? For the investment business that I do, like I'm not working magic. I'm just having a conversation with you to understand how you think about money, how you feel about money, what's your risk preference when it comes to investments. These same questions that I'm asking, or I'm sharing with you all, are the exact same questions that I ask all of my potential clients, or even current clients. Because even after some time goes along, I still want to check in, because as life changes, so should your plan. So if you were always a risky investor, and you've made some good money, maybe it's time for you to dial it back and bank some of those earnings and put some more in cash to beef up your reserves. So this process is fluid. Like once you make a decision today, it's not in stone. But I hope that all of you consider working with a financial professional, because what it does is it takes some of this burden off of you. See, many of us are trying to do this all by ourselves. We're like, I'm gonna watch some stuff on the computer, my phone, listen to my friends, and then I'm gonna open an account and start doing stuff. And I swear to you all, I have all these clients who have these, I'll call them small investment accounts, but they don't know what they're doing. They open it up because they thought it was the cool thing to do, and they've made a few dollars, if that. Some of them got lucky, but for the most part, they don't know what they're doing. So I always follow up and say, why do you have that account? And let's do some, let's backtrack a little bit. Why did you open this account? What was the goal? Are you even adding any additional funds? Is this one of those you're going to set it and forget it type of things? Like, just give me more than just, well, I got this account, so I don't need you, Jasper. Let's answer some more questions. I'll see if we get to the bottom of this. So John, yeah, Joan. So in light, the questions around like smaller deposits, you know, she says as low as 1,000. Oh, there are apps you can do $5. So we don't need $1,000, you know. So there's some apps. I usually don't give those apps any free marketing, but you can find them if you search the internet for investment platforms for the newer investor or for the investor with smaller deposit or low minimums or no minimums. So you have some programs out there. You're not going to have a lot of options in terms of what you can do. So there are some platforms that have some prescribed portfolios based off your risk and like time horizon, that if you open it up for, I'll say, smaller dollars, they'll just automatically invest those smaller dollars. Some people have, if we're talking about stocks, sometimes you can do like fractional shares of a company. And so that may require, hey, I only have $20. How much of this company can I buy with $20? So you may get fractions of a share of a company. And those became popular over time because some people just couldn't afford the cost of one share of Amazon stock, which I think is still like $3,000 something. So, you know, maybe you get a fractional share of an Amazon, or maybe an Amazon is in another type of fund that you can buy into that has Amazon in it. So you have a lot of options, Joan, to really think about. And so if the $1,000 is kind of that starting point, it's a good drop in the bucket to start out. And so if that's going to serve as like that test program for you or whomever, give it a shot. You know, the key thing too, when we talk about how much, this is the key thing with investments. Don't invest money you need. Let me say that again. Please don't, because this is that conversation around how much you can afford to do. Don't be out here investing your rent money. You know you need that next month. You know you need that next month. I need you to not be out here gambling the rent money. You know, I hear people who complain about interest rates and will say, well, I'll open up an investment account because that'll get me better returns. Well, that may be true, but what if the day you need the money, the stock market is down or your investment is down? Then what? So when people say, well, Jasper, do you always recommend an emergency fund should be in like a savings account? Absolutely. We can always gamble and see if we get lucky with the other investment. But if I know I need the money, that's money I should not be investing. Give me 1 second, everybody. All right. So after we get through how much and how frequent, let's just talk about the basics. So let's go through a couple of the basics again, keeping this high level, everybody. Definitely want to encourage everybody to go out here and do some research on your own time, but, you know, understand what the basics are of a stock. If somebody could indulge me for the moment here, can somebody give me a simple definition? And I mean simple or very basic of what a stock is. And it could be a short sentence or a phrase, or it could be one word. But if anybody wants to post in the chat, like what is a stock? Because a lot of times we use this language and we're not really sure, like, well, I heard people say I need stocks. Do you even know what it is? So if anybody wants to, again, a quick or simple, easy definition of what a stock is. We already have a winner. Yep. You got it. It's ownership. Thank you, Matt, for sharing that. But yeah, ownership. It's a share in a company, a small piece of ownership. Exactly. If somebody says they want to get into stocks and I say, what is a stock? And they start to freeze up on me. If they just said ownership, I know they have some level of understanding. That is what a stock is. You own some portion of a company. And I don't care if it's a fractional share, but that's how much you own of that company. You are an owner. And so when I do investment conversation with youth, I start to try to change how they think and feel about money, right? So I always say, if you own stocks, and let's say it's a company you all are familiar with, I always say, I appreciate you supporting my company. Or if you're wearing your company's apparel, you say, I appreciate you supporting my company. And for kids, it's such a cool thing because most kids are like, what are you talking about, your company? You don't own Nike. You're just wearing their clothes. Well, actually, I own some stock in Nike. So therefore, I am an owner. Like, think about how that changes the landscape and the dynamic of our youth if they understood ownership. And so stocks are pretty cool, y'all. You own a little bit. Give me 1 second. I want to respond to something here in the chat. One second. All right. So yeah, my standard, so Mr. Medina, yeah, with the Jordans, and that's actually how I explain stock ownership to kids. Actually, I'll tell y'all this story. I do it every time. So when I'm in a room with kids, and I do a lot of community work and volunteer work, or I have done over the years, and there's always a couple of kids with a pair of J's on, and I'm always excited because I know that it's the perfect setup for, like, here's why investing is cool. And so I always I ask the kids how much they paid for the shoes, if they paid for it or somebody else paid for it. And then I go around and shake their hand and say, thank you. And the kids always have this perplexing look on their face, like, what is he doing? I'm like, I want to thank you. I want to thank you. And I shake their hand. I start smiling. And I'm like, what are you talking about? I'm like, I don't own a pair of Jordans. I've never purchased a pair of Jordans, but I've owned Nike stock for the longest time. And I tell the kids, I've never met you until today. Like, I just met you today and you have already made me money. Could I interest you in investments? And there's always that one kid that that his head just explodes, like, oh my God, this is incredible. It's the simple concepts, I think, that if we can break down some of these complex subjects and topics into like a scenario like that, that should incentivize some people to invest. I have my wife loves Target, and I'm like, do you own Target stock? Because every time you walk in, you tell me you're getting one item, you walk out with 6. And she's not the only one that does that. Somebody on this session is obsessed with Target and probably owns no Target stock. I mean, it's just one of those things, right? We're consuming and not realizing that we could also be owners in the same vein. And there are some books and strategies that talk about, with investments, investing in what you know and investing in what you support. It is a viable option that, people consider. So it's just, stocks ownership is the key word I want you all to take away from that. All right. So next up is bonds, just because this is what everybody talks about, stocks and bonds. So can anybody give me like a basic, short, simple definition of what a bond is? And if not, it's okay, but just short, sweet, just, it could be one word, it could be 2, a short snippet on what a bond is. Matt is on it again. Bonds are debt instruments, y'all. So bond means somebody owes some money and they're making payments by way of interest to you by holding that debt. So again, some of these things too, there's some great resources out there. I'm going to share a source here in the chat now. And this isn't the only site. Let me share this one with y'all while I have it. So I'm going to post a site in the chat. I'm very fond of it because if you go to it and go to, hold on, let me make sure I type it in right. If you go to Investopedia, and then they have a whole section on definitions. They have an expansive glossary. I'm sure other platforms do as well. I just became fond of Investopedia over the years because on a lot of their definitions pages, they have short videos. So, at first I wouldn't read all these articles. I would like, do you have a short video that can explain this to me? And so, like, what is a bond? What is a stock? And Investopedia can, write out the full definition, but they had a lot of videos. And I was like, this is how some people need that visual, right? To see, like, this is what a bond is. It's a debt instrument. it is one of those, like, bookmark these websites and just when you're trying to it'll sink in at some point. But I want people to know the basics. Oh, nice. Yeah. Yep. Investopedia, they have an expansive definitions section, or the gloss. Yes, definitions, but they have so many basic financial concepts that you might just hear in passing. If we just understood some of these things, you gotta go educate yourself. I swear to you all, it is not as hard as maybe the world has made you think to become a good investor. Maybe you don't become great. Maybe you don't get real creative. Tried and true and old and boring and stuffy makes people a lot of money over the long term. You don't have to be super risky or aggressive to make a lot of money. You just got to be consistent. Put money in, do it over a long period of time. You'll probably make some money. So a mutual fund, if anybody has a short one here, you feel free to punch it into the chat, because again, mutual funds are another great vehicle. Very good, I would say, for the novice investor, just because there's a lot more, if we're looking at the risk perspective, a lot more risk when you're dealing with one company's stock, right? So you're hoping that this one company does great, or else your whole life is over. So a fund, and if anybody wants to type in you don't have to, if you want to type in a simple or basic definition for a mutual fund, you can. But here's how I break it down to people. And there's, again, on most websites, there's a video that will talk about what is a mutual fund. I like to think of it as a basket full. We'll just go with stocks. So let's say I was into tech, and let's say, we're on Zoom. So maybe I got Zoom and Microsoft and Google and Amazon, all these tech companies. Maybe I can't outright own their individual stocks, but within this fund, the fund manager is saying, I want a little bit of all those stocks that I'm gonna purchase and bundle into this fund, that somebody who only has, let's say, to Joan's example, $1,000, they want to get that diversification. They want to get all those tech stocks, but they can't outright buy them individually. The fund comes into play. So I like to think of it as like a basket full of, it could be stocks, it could be bonds, it could be a mix of other things, but it's a way to allow the person who doesn't have, again, all the monies to maybe purchase the stock outright, but they want some exposure to that company. Mutual funds are primarily what you'll find in your employer-sponsored retirement plans. So you may have a variety of mutual funds that your company's plan offers you. That's typically where you'll find a lot of these. And I want you to know that that's what you have. And what's neat about this is I meet people who tell me they don't understand, or they're not investors, but then they have a retirement account. And so that retirement account through your job, you're invested in the stock market. So you are an investor, despite what you might tell yourself, you are an investor. So it's those types of small things that, if we get past that and understand that maybe my only investment account is my 401k, great, you're still in the market. So you need to have a basic understanding of these things, so you'll feel more comfortable putting more money in and taking more risk. And so the last one is more of a, they came along, they're funds in a sense like mutual funds, but they trade, these exchange traded funds or ETFs, they trade like stocks. So throughout the day, you can buy and sell the fund. They're similar to some degree to mutual funds. And so one of the primary differences is you can trade them throughout the day. So a mutual fund, if you were to say, hey, today I want to get into this fund, the price isn't set until the end of the trading day. But the ETF or exchange traded fund, you can buy it throughout the day, kind of like a stock. So it can go up and down throughout the entire trading day. And they became popular because their fee structures are slightly favorable, depending on which types. They can be more favorable in some regards than mutual funds. So they became very popular over the years, simply because of a cost standpoint, where these ETFs track what are called like an index. They track a lot of companies, maybe in a particular sector. And so it makes the manager, like the money manager, their job is a lot easier when they're tracking more companies. And so they bundle them into these funds. You can actively trade them throughout the day. Could be an option that you look into. Again, when you're starting your investment program, just take a look and do a little bit more of a deeper dive into these exchange traded funds. Because to Jones, I think it was Joan who asked, if I have, again, $1,000, well, I can have $1,000 into a fund that is providing a ton of variety by way of investment. So again, knowing some of these basic things is very important. Again, I don't have enough time to go through all the ins and outs of each and every one of these, but I think knowing these, like these are typically the basis of like a lot of things we like that you see and hear about. It's usually a stock individually, it's a bond individually, or it's bundled into a fund of some sort. That's typically what you'll find, but I just want to make sure everybody understands the basics when we're talking about investments. All right. So before I talk about the shiny new toys, I want to address, I think it was Mr. Medina mentioned the meme stocks, and I'll tell a quick story. So the meme stocks was this crazy time during the pandemic where you had companies that were trading at relatively low prices. And then I believe it was Reddit. I'm not really active on Reddit ever. So some news started breaking. They were trying to stick it to these hedge fund people who were manipulating the markets. And so they said, we're going to, they started single-handedly like picking out certain companies and these stocks. There was a handful. It was AMC, it was GameStop. So GameStop is the one that just started popping, and everybody's like, why GameStop? Well, I'm sure there's a lot more to that story, but the idea was we're going to stick it to the hedge fund people who are always taking advantage of the smaller investor. And so the price ran through the roof. And here's the funny thing about GameStop, everybody. I had an account that I had one share of GameStop. I had one share. Yeah, Mr. Medina. Yeah, it's a long story. We definitely have time to do a deep dive here, but it was a way to show that if people band together, markets can be moved. And this was an example. This meme stock experience was just that fact that if people come together, things can happen. And it's all legal. So let me tell you that it's legal what they're doing. But you know, GameStop, again, I had a share. And I was hearing the news and I was watching it, and I forgot I had this one share of GameStop because I had this stock I was gifted through this app I was on. I received that one share back in 2019, and it was trading at like $4 a share. I'm not into video games. I didn't really do a deep dive into GameStop's like, you know, records and history and their performance, but I had a share. And so when GameStop went through the roof, yeah, I watched it. And it got up, I think it was hovering around $400 a share. And I sat, and we talked about timing a few slides ago. I sat and watched it go down a little bit more. And it was so hype. There was so much hype around it. So I said, you know what? This can't last forever, because this is a moment in time where there's so much attention that it's going to run up and it'll fall back down. And so I sold my one share at like 370 something. And the very next day I woke up, it was back trading at maybe 115, 120. I'm not sure where it's at today. If somebody wants to punch that into the chat, but you know, it was a wild ride. And so when we have, I like to call that one of those shiny toys, these meme stocks, is there wasn't much backing as to why they, you know, well, could they sustain those long term is always the question. It running up to, thank you, Mr. Medina, it running up to 468 a share was unheard of. And the crazy thing is that some people got lucky and bet that was going to happen based on this Reddit group that was talking about, we're about to do this thing. And this guy, he didn't disclose his name, but yeah, he made, I think, $4 or $5 million because he did some reckless, very risky stuff. He closed out, he had an old 401k, he closed it out, took the money, which so he was gonna have to pay taxes on that at some point, and then invested all that money into GameStop right before the run-up happened. He made maybe $5 million off of that. And super risky move that he made, but things like that are the shiny new toys that I want the newer, the novice investor, don't get caught up in it. And I have to mention these next couple of shiny toys because it's on everybody's mind. We talk about them all the time. Not going into detail tonight, but it's cryptocurrency and non-fungible tokens, or NFTs. And so what I am going to do for you all, let me see here. I am going to, I think I have the links up. Let's see. I'll do it towards the end. I make a note. I'm just going to share some videos, some links with you all. And I want to say they're from Investopedia. If you're not sure what these two things are, you're going to get a basic definition. Take your time and read more about cryptocurrency in general and NFTs. It is a hot topic. It's the new shiny toy that's distracting people from, I'll say, really having some strategy around their investments. And it just bothers me. And I left myself a reminder, please watch the links. Just watch the links, y'all. People are trying to leverage or use these options as, I like to call them, the lottery ticket. And it may work out for some, it's not going to work out for most. And when I say for most, it's the people who shouldn't be doing it. The people who don't have hundreds of thousands of dollars or millions of dollars to really play with are doing these strategies and crypto schemes. And it may work for some of you. For the overwhelming majority, it's not going to work because you don't have enough money to really wait it out, right? There are days that it's good, there are days that it's bad. Can you ride that wave? You know, I had some friends who were into crypto very early on, and it worked out for them because they were in it before everybody was talking about it. So I had friends who were in Bitcoin well before Bitcoin had its big run up. But we're past that moment, everybody. The world is very clear around cryptocurrency and what it can and cannot do. But some people just are holding on as if it's going to be their savior and it's going to take them to the promised land. Here's what I do for my clients. I don't give advice on cryptocurrency or NFTs. If you have disposable income, discretionary income that you do not need, and you want to dabble with the shiny new toys, whether it's these meme stocks or crypto or NFTs, by all means, good luck. There are other people who they're doing trading. They do like different academies so you can learn more about them and all that good stuff. There are some people who may be making some money. I don't know them. I don't know them that well. I don't know them enough to send my clients there because we think this is going to be the next big wave, and it may work out in the long run. That's all I'm going to say about crypto and NFTs. It is a new shiny toy that is distracting us from actually doing some of the tried and true things that we should be implementing. And here's my example. I had a client. This was last year. This was October. She sends me a message saying, I want to invest $15,000 into some coin. Never heard of this coin. And then she says to me, well, I have a friend who works, he's some investment guy. And I said, well, I don't think this is a good idea because I think there's other things in your financial plan that you should be doing before you take this gamble. Now, her thinking was, well, my friend told me about it. Seems like a good idea. He's in the industry. He understands this stuff. He's explained things to me. But I was like, is this in your best interest? And she was like, I don't know. I just want to do it. And I said, cool. But is there anything else we should be doing before you do this? And that anything else was maxing out her 401k account. Again, we're going to talk about retirement on Thursday. But I was like, before you drop, and she was going to put 15,000 into this coin that was all the craze. I said, before you do that, let's put in more money to your 401k because I know that's tried and true. I need you to do that first. And then whatever else you want to do after that, because you still have some discretionary money, I said, then you go do whatever you want to that coin. So, of course, what do y'all think happened? Now, I'm a financial planner. I was doing planning with this client, and she hit me out of the blue with wanting to do this crypto play. Does anybody want to take a guess as to what happened to my client with this investment she made? Any guesses here? So she hits me up, wants to do 15. She, we have a talk about doing some things. She did do it. I'll share that in a second. She made money? Absolutely not. And it was definitely not a boatload of money. So here's the kind of guy that, so after our talk, after we set up the 401k approach, like we did all the other stuff first. She ended up investing 10,000 and not 15. She did not become a crypto millionaire. And I told her, I said, it didn't work. Now her friend, all y'all lost. Yeah. Mr. Medina, you said it. She had FOMO. The fear, she was afraid of missing out because she was listening to the stories and stuff on Reddit and following all these different, message boards, and it didn't work out for her. And I said to her, I'm not saying that it's a bad place. I just want us to think about, is it the right thing right now? See, a lot of us are skipping like all the other courses that we've done in this session, in this series. They skip all of that and then skip to doing crypto and say, I want to do this. And then you just do it. There applies some more important things in your plan that you should have done first. Like, I have people who hit me up consistently around crypto and NFTs who have bad credit, no emergency savings, nothing for retirement. And I can go on and on and on. So I'd rather you do all those things first, then go play with the shiny new toy. That's all I'm asking, y'all. That's all that I'm asking. I know we all may know somebody who's made some money off of crypto. Yes, I do too. But they didn't do it over the long haul. They got lucky, y'all. They got lucky. Their timing was great. But nobody that I know close to me is still doing this. Now, wealthy people, I'm trying to make more wealthy friends because a lot of them do this stuff because they have the money to play. They have the money to play, right? So some people made some money on Bitcoin, right? And if you've made some money, great. But what did you do with the earnings? Did you double down and buy more Bitcoin because you thought it was going to get to 100,000? Because it kind of fizzled out after about what, 60, 70,000. I'm not sure the exact number, but everybody kept saying it's going to get to 100. Maybe it does, but it didn't do it right away. But when it falls out of favor, again, we'll all stop talking about it for a while and then it'll surge back again. But these shiny new toys distract us from what we should be doing. So here's a diagram I want to show y'all. This is the S&P 500, which is one of the most popular indexes that tracks, I'll say the 500 companies, but it shows the returns from 1927 till year 2020. Now, just first glance, there's way more green than red. So when people say, I don't want to invest, I'm scared of the markets, it behooves you to get invested. And if this diagram is not a good enough reason, I don't know how else I can sell you on investing. And if you notice, and I'm going to look to my far right, there's a real long red line. That is 2008, hence that poll question that I asked. We had an incredible, what they call bull market run from roughly that low of in 2009 to about 2019. Even despite a little blips of red there you see, and that next, I'll say, aside from that little blip of red on the far right, if you count 1, 2 from the right and go left, that dip is, I think that's the pandemic. No, I'm tripping. It's the last one is the pandemic. We're in 2020. But look at that, y'all. Look how much green is on that chart. So think about all the natural disasters. We're in a war, Ukraine and Russia are going at it right now. Oil prices through the roof, inflation. We've been through recessions. We've had 9/11. We've had stock market crashes in the past. Just look at the green. So when people say to you, well, I'm just going to keep saving money and playing it safe and working hard, they're never going to be wealthy. You're never going to reach your financial dreams and goals just saving and working hard. And I don't say that like lightly. Like, we have to invest. If we want to really do some things in this lifetime, we've got to be willing to take a chance on the stock market. This chart here, again, if anybody is concerned, this hopefully is helping you to understand this is how good it could be for you if you play the long game with investments. In these short-term windows, it gets bumpy, but investing isn't something that we should be fearful of because it makes a lot of people a lot of money in this world. Why are you not participating? That's the question you got to ask yourself. If you say you don't have a lot of money, well, let's start where you are. If you got a lot of money, let's make sure your plan is working out in your favor. Again, I don't judge people on what they decide to invest in. I just want them to be invested and understand their risk preference, understand their time horizon, understand how much, how frequent they're putting money into said investment. Investments is a very, very good thing, you all. I just wish more of us would do it. I wish we would start earlier in our careers, but nobody tells us this stuff. All they tell you is go learn something, get a job and make money. Well, that's how you make more money and not work so hard. Can I interest anybody in just having money work for them? I take that up, right? I want to work hard and work smart, but I want my money to also be working for me. So hopefully this diagram is a a good indication of why investing is a good thing and you should be invested. Stay in, y'all. Time in the market is better than trying to time the market. And then I'll leave y'all with an investment tip. This is on the house. So my advice is to invest in tennis balls. They have a high rate of return. And there's my friend right there. That's my financial planner, Scruffy, giving y'all a tip. Everybody wants a stock tip or an investment tip. And so I'll end the presentation with a little bit of levity there. And so I'll stop the share here for a moment. And I want to get you all those links that I'll post here in the chat that were around like cryptocurrency and NFTs, just so that way you all have that. So if you all can bear with me a moment, I'm going to get back out there and get those links for you, and I'll post them in the chat. Because again, it's all about educating yourself and just making sure that you're doing, again, what's in your best interest. But I think having a good foundation is what I think more people need, because when you have a strong foundation, it's easy for you to make those investment decisions. So these two videos, and they are Investopedia links that, again, will give you some basic information around cryptocurrency and NFTs, because a lot of people are curious about how they operate. Just take some time and go through it. You're not going to figure it out after watching the video once. It's still not going to make sense. So maybe you chart out a plan to where you do a little bit of research every week. Just kind of get comfortable with the terms, the lingo, some strategies that people might try to implement with using those ideas. But for me, it's I tend to stay away from those types of things. Why? Because I got other things I'm focused on with my investment strategy. But by all means, if you think that's a way you want to go, and again, I think some of you alluded to that you've had some success with it. Great. A lot of people did, but I find people who aren't as savvy with investments trying to get in hopes that it's going to pay off quickly. And I just want you to be mindful that there are some things you should do first before you hop into something like cryptocurrency or NFTs. Just my recommendation. Take it or leave it, but you grown. So I know we're about 5 minutes at the top of the hour, so I wanted to be, again, respectful of everybody's time. And this one hopefully was good. It's a topic that we all like to talk about, but we may be trying to sort out our own strategy. And I think you just want to give it a lot of time to think it through. Don't be in a hurry to make some of these decisions where if everybody's talking about it, it's probably, it could keep running up. It could crash shortly after. You don't want to always be going with the crowd sometimes with investments. You want to get into stuff well in advance before people are into it. And this is, if there's any indication of this, you think about publicly traded companies, all the people who got in very early make the most money. So by the time it goes, it has this initial public offering or goes public, the people who got in the earliest made the most money because the shares they receive were at a substantially lower price. So although the stock price may start out at like $15 a share, some people got in at like cents, like 18 cents a share, 20 cents. So all those shares at $15, they still made millions of dollars. So yeah. So hopefully that was helpful tonight. Again, that was a high level, and I keep it high level intentionally because hopefully that will allow some of you to kind of think through your investment strategy more in depth. And for those who maybe or have been nervous about starting an investment program, hopefully I've covered enough of the basic concepts that would allow you to kind of take that step. There's a lot of free information out there, which I would encourage all of you to just keep going, keep learning. But at some point, you gotta just do it. You gotta try it out. If you're still like, I wanna maybe practice, I didn't think about this. There are some investment simulators where they give you like monopoly money that you can set up an account and do trading on real companies, but it's all fake money. So if you want to kind of cut your teeth and do, I forget, there's a Investopedia might actually have one if I'm not mistaken, but you want to take a look at maybe a simulator to try your hands at it in a practice setting. But here's the problem. When you get good, that's fake money you're making. So it's not going to feel good. I had a buddy who was killing the game doing trades in his simulator. And he was like, man, if this is my real money, I would have had $1 million. I was like, well, put some real money up and stop playing. get in the game. So maybe a simulator is an idea or an option for you to consider as a way to kind of take that step if you're not comfortable putting up real money, or even if you have a little bit of money you want to kind of play with. Start small. Start small, see how things respond. You want to add more, add more. If you want to sit back and take it back out, do that. But you got to at some point get in so you can get the experience. Because I know this, over the long term, the investments in the stock market will outperform your bank account. That I do know. I can't guarantee it, but I'm pretty certain that over time, I'll get you better returns, or the market will get you better returns than the safe money. So, all right, y'all. We got another minute left or so. I think we had not too many questions tonight. I know everybody's kind of just soaking this in. So take your time, y'all. Take your time. We still have one more good session on Thursday. We'll wrap this 6-part series up with the retirement conversation. So again, I just want to thank you all for rocking with me again tonight. And yeah, so looking forward to one last session on Thursday. So Charla, anything you want to say as we close it out? I know people.
No, just thank you again for another fabulous training session. Everybody seemed to get a lot out of it this time, especially for investments. And we will see everyone on Thursday, same time, same channel.
Yes. All right, everybody. Have a good night.
Good night.
All righty. Bye-bye.
Bye-bye.